Okay, I'll have the double responsibility of
no pressure, Dave,
and manning the door. Brilliant.
Indeed. So warm welcome to everybody. Good morning. Thank you all for joining us. These seminars kind of something that we've done for a number of years now. We were always wanting to bring new ideas to clients, whether that's investment ideas or planning opportunity ideas. Obviously, previous to last year, we used to do these face to face. We used to run events, but obviously we've had to adapt, as we all have, and we're running these events online now. So yeah, I mean, this morning we're in for a really interesting session with Dave. We're going to be, well, Dave's going to be talking about his company Praetura. Dave's the MD of Praetura Ventures. They run an EIS, an enterprise investment scheme, which provides venture capital for sort of early stage companies. We've sort of worked with, and we've had contact with Praetura for a couple of years now. Really like what they do, really like their process, really like the focus. They've got sort of a northern focus, whereas a lot of venture capital historically has been done down in London. Praetura take a more northern focus on that. We like the fact that it's not just about the money, it's not just about the capital investment. They will nurture and work with those early stage companies to grow them. They've got a strong network of contacts, a lot of resource, a lot of experience in this sort of area. So, we think it's a really exciting investment opportunity, and that's really important. The investment part to us is the priority as your advisors. The investment part has really got to stack up. It's not for everyone because it is at the higher sort of end of the risk spectrum. But yeah, we really do think that there's a really interesting story, Praetura. And in addition to that, there are some benefits from a tax perspective. So we're not driven by those tax benefits. They're an additional benefit to invest in an EIS scheme. So as you may or may not know, any investment into an EIS scheme would qualify for a 30% tax relief, which we'll probably talk about a little bit as we go on. So I don't want to go into too much detail and Steve Dave's thunder. But yeah, hand over to you now, Dave, and yeah, I hope you enjoyed.
Okay, I will quickly try and share my screen. So hopefully you will be able to see the screen.
Yes.
Yeah, got that. John says, so I'm MD and founder of Praetura. Today I'm planning to talk more about the investment than the tax reliefs, but probably at the end, Steve, who's a colleague of mine, can talk through some of the tax reliefs and the tax planning angles. But for me, venture capital should always be about the investments, not the associated tax relief. So that's what I'm going to focus on in terms of the presentation. I'll try and whiz through this in about 30 to 40 minutes. Feel free to stop and ask questions along the way. Alternatively, we can run through any questions you may have at the end. So whatever works for people on the call. So who are we? So we're Praetura. Since we started in 2011, we've built 3 businesses. So Praetura Ventures is one of those, and that's the business that I run. But we've also built 2 other businesses that lend money to SMEs. So Praetura Asset Finance, we set up in 2014. That's grown to about £115 million lending book and has a securitization with NatWest Markets that goes up to 300 million of facilities for that business. I've got someone to admit, so let me do that. We also built Praetura Commercial Finance, which we started in 2016, which does invoice discounting. And prior to the sort of, I guess, the beginning of the pandemic, we'd grown that business to 60 million of lending book. It's obviously shrunk slightly since the pandemic. Invoices generally have reduced for the types of businesses that business funds. Overall, we've grown the group to 8 employees. We've got about 250 million of AUM. We've invested or lent about 400 million. And in 2020, we achieved sort of 20 million of revenue and 4 million of EBITDA. So we're a relatively established business, despite the fact that Praetura Ventures has only been running EIS funds for.
What? You've done it, yeah. So you just click on the links.
So as a venture capital business, we're here to help and support early stage businesses to grow. That's kind of what we do. We've had some reasonable success as we've gone through sort of the journey of Praetura Ventures. So prior to launching our first funds, we did deals deal by deal, and one of our first deals was PLC, where we bought, pre-IPO funded, and then floated a business that does energy consultancy on the Fylde coast. We grew that business from about 1 million EBITDA to about 20 million EBITDA. And for the first few years post float, I was the FD of the business, which meant that kind of my first job in a finance function was as FD of a PLC, which was a bit of a baptism of fire, I'll be honest. But really that kind of led us on the journey of, when we're investing in early stage businesses, one of the things we do try and do is add value and participate in the growth of the business post our investment. PIB is a business we were the first founders of back in 2014, 2000.
You're having a meeting with.
We sold that business after 18 months to Carlisle Private Equity, where we achieved in 18 months a 4 times return for our investors.
Dave, could I just interrupt you for 1 second? Could I ask everyone to go on mute, please, because we're getting a bit of background interference. So could everyone just go on to mute for the moment, please?
Thank you, Angela. So PIB, I noticed, was had recently been sold from Carlisle to Apax for about £1 billion. So since we sold it, has obviously gone on and done exceptionally well. The reason we sold it was because Carlisle were offering to put about 250, 300 million of buy and build firepower behind the management team, which obviously was something that we at Praetura couldn't do. But it's great to see kind of a business we were involved in at the very early stage go on and be so successful. EC3 Brokers is another business we've exited. We were the first funders of that business. We invested £600,000 and we returned £12 million of cash to our investors on that deal after about 4.5 years, where we sold it to BP Marsh, a specialist insurance private equity business. And then 2 businesses with the green blobs on top are 2 businesses that we're still involved in. We've invested these for a while. We first invested at kind of 3 and 4 million pre-money valuations, and they've both recently raised money at north of 50 million valuations, with, you know, sort of large scale multinational VC houses. So those businesses have gone particularly well during our sort of period of ownership. We didn't, as I said right at the beginning, we did things deal by deal prior to launching our first fund in 2019. If we take all of the equity investments we made between 2011 and 2014, that's the first bar on the left of this screen. We have returned 3.8 times money to our investors, and we have just shy of about 3 times money still available for return. So both I think Sorted is in that sort of 2.7, and there's another business called Artorius, which are going very well, which is in that kind of 2B returned box there. And then between 2014 and 2016, which is the second bar, we've already returned 2.2 times money to our investors, and again have further to return to investors. Both of those sort of cohorts or synthetic funds do include failures. John mentioned right at the beginning, this is a risky asset class, and that is true. It is higher risk than, you know, a number of investment opportunities. We do expect within any portfolio to have some failures, but we believe that by diversifying funds, spreading the sort of risk amongst a number of businesses, we usually aim for 8+ in any particular tranche of funding, that the opportunities for outsized returns sort of mitigate the sort of risk of zeros from some of our investments. And then, you know, compared to our peers, you know, we've been generally doing pretty well compared to our peer group within the industry. Over the last 18 months, we've raised £31 million of EIS. We have assessed £2.8 billion of opportunities. So that's companies coming through our pipeline requesting funding, and we've made 13 investments. So we've been pretty busy. That is including the fact that over the last 9 months of 2020, we only did one new deal because obviously the pandemic threw everything up into disarray. We decided, from a business strategy perspective, to redeploy all of our team to helping the existing portfolio rather than looking too hard at new opportunities. And to be honest with you, for probably 6 months of 2020, we just didn't have any confidence in anybody's forecasts because nobody knew what the world was going to look like. We're now on the cusp of doing about 6 new deals where we feel much more confident of being able to invest. I think the world, despite the fact we're in lockdown, has settled down somewhat. People are beginning to buy new products. People are beginning to sort of engage in a normal fashion that we would expect to see, and I think it's really important that we look at those businesses with the positive attitude of people exiting from lockdown and beginning to start acting normally again. I'd mentioned diversification right at the beginning. So diversification is important to us. We diversify funds across kind of sectors. So you can see in the middle there, lots of different sectors. We also look at kind of end customers. So we don't want to be always serving the same customer base. So while some of our businesses are tech platforms that serve e-retailers, for example, we wouldn't want to have everybody serving the same customers because we don't want that concentration risk. In terms of size of companies we back, we're looking for diversification there as well. So seed being the very early stage businesses that we're looking to back, and growth being kind of the more mature but still venture capital businesses. So those are sort of businesses where we're looking at valuing them at north of 20 million quid. They have, they've gone way past sort of proof of concept. They've got their sort of way of working and their product market fit, and our cash is usually used in that regard to accelerate sales, accelerate growth. The one area we're less diversified from, and this is something again John mentioned right at the beginning, is our region. So we focus heavily on investing in the north. We don't only invest in the north of England, but about 2/3 of our funds will go into the north of England. I guess that's a bit of an ideological view and a bit of a pragmatic view. So we think there are huge opportunities to be had in the north of England because, as John again rightly mentioned, there are very few, the majority of VCs are in London, and there are very few people who are looking to do this in the north of England. So we are in a relatively privileged position in that we have the sort of access and the choice of the best businesses in the north of England, who a lot of founders in that space want to have a local regional funder to back them, particularly at the early stage. We also think there's a huge opportunity from valuation perspective. Founders in the north generally have less outrageous valuation expectations than they would in London, and that gives us an opportunity. If we can sort of buy locally and sell nationally and internationally, there's a huge valuation arbitrage opportunity there, which is something we're beginning to see with the likes of Peak and Sorted, as we talked about at the beginning. In terms of what we do, I think an EIS VC or a VC generally has sort of 3 jobs. The first is to provide the investor with a diversified portfolio of investments in line with the strategy, and it's important that investors who invest with our fund, understand our strategy and buy into what our investment thesis is, because that's what we are going to do when we deliver investments into the portfolio. We try and add value to a portfolio post-investment. We are an active investor. We don't try and run the companies, but we're definitely a far cry from sort of non-execs who sit back and attend the board meeting, eat the sandwiches and offer no value other than that. We are actively working with our portfolio on a daily, weekly, monthly basis, and we're constantly looking at ways we can add value and make their businesses better, stronger, and faster growing. And then the final thing, which I think has been done relatively poorly within sort of the EIS community in particular, is communication with investors. So we try to provide open, honest, transparent communication with all investors. We are very happy to speak to all investors in the fund at any time to answer any question. and we make sure that we tell, I guess, the story, both the good and the bad of what's been going on within the portfolio. So it's very important that, you know, to us, that investors understand where their money has been invested, and then what is going on with the portfolio into which they are exposed. In terms of sort of how we get to what we invest in, the investment process is we look at things on what we call kind of 5 M's framework. Initially, we're looking for business models that match sort of what we're looking for, which is recurring revenue, opportunity for operational leverage, minimal working capital cycle. Those business models are where we have had the most success historically. Where those business model traits haven't existed, we have done relatively poorly, because whilst I mentioned some fantastic investments earlier on in the presentation, it is important to note that we've not got everything right. But when we look at what we've not got right, where we've made poor investment decisions, it's important to us that we learn from those. And we think now that our investment process, or investment thesis, has been kind of proven across a number of opportunities, and also where we've got it wrong, we've really learned from those and are trying to avoid those mistakes again. Market, we're looking for things where the north of England has a competitive advantage, or at the very least not a competitive disadvantage. The market has to be big enough to make it exciting, and usually sort of we're looking for attractive niches within big markets. Where we spend most of our time, though, is around assessing management and assessing momentum. So management, the important point to note here is we don't back individuals. So where we've sort of seen individuals try and run businesses and be almost the autocratic, all-seeing, all-knowing founder, we don't believe that's a particularly scalable model. We're looking to back teams. So we're looking for a team of people. One of the things we insist on is someone from a finance perspective, a finance background, so someone responsible to the board and to us for looking after the cash that has been invested. And we're looking for a team that works well together, and particularly one that has a strong cultural fit with us. So we're very sort of values-led. We're very, how we go about the business is important as what we do within business. And in terms of what we try and match with our founders is a strong cultural fit, because it is inevitable in venture that things won't go 100% to plan. And it's important that you really, really enjoy working with the management teams, because if you don't enjoy and don't love them on the way in, when things go to plan, it makes things very, very difficult, to assess and to try and help them come out the other side of it. The big thing we look at from a diligence perspective is momentum. So momentum is kind of our catch-all for things that point in the right direction for the business. So we are not a particularly quick investor. We probably spend 5-6 months working with a business before we invest. And one of the things we do is we spend a lot of time assessing their pipeline during that process. So we would always customer reference. We would always reference businesses in the pipeline. And this is probably where most businesses fall over, because it's amazing how many founders come to us with a hugely impressive looking pipeline of new opportunities that are just about to sign contracts, that when you talk to those businesses on the pipeline, they kind of they've had a demo 6 months ago and heard nothing from them since, and aren't really in a position to be buying anything anytime soon. We do that diligence internally, but we also use external diligence to do that work. And the final thing that we look for, and I guess going back to momentum, actually one thing that's important is, like, free trials don't count. Pilot schemes don't count. This is about people paying proper money for a proper service for a proper contract, not kind of free trials because anybody can sell something to somebody for free. And the final part of what we look for is more than money. So this is kind of us looking at ourselves and working out, how are we going to add value? How can we help this business perform? So that might be our contacts, it might be our expertise, it might be a specific need within the business. But if we don't think we can help, or importantly, we don't think the founders want to have some help, then we won't invest. We're not the right investor for them. So we would self-select out of those if we don't think we can add value. Post-investment, we try and do two things. We add more than money, so add value, and we try and have open and transparent communication with our investors. In terms of sort of how we add value, we've kind of got a number of ways we do this. First things first, we have built our own portfolio reporting platform. So we went out to the market to find something which would track performance of a portfolio over time. We didn't see anything we particularly liked, so we spent 2 years building our own. That takes data directly from the company's accounting software, and from a set of kind of mandatory and optional KPIs from a KPI bank. The businesses input their numbers via a direct upload directly from their account software, I said, and that then produces kind of a matrix on a zero-touch basis across our entire portfolio, which monitors performance against certain metrics within the budget, growth rates within the business, and also cash runway, taking kind of amount of cash they have versus their average monthly burn, and sort of puts those into a risk matrix so we can see where we need to focus our attentions on the portfolio. So it's not always focusing on the ones that are kind of performing the worst. Sometimes the actual benefit is to focus on our efforts and time on the ones who are performing the best, so we can drive further drive the return from that business, rather than always focusing all our time on the worst. But the great thing about solution is that it gives us, on a zero touch basis and easy for the portfolio companies, it gives us great data. So within 10 days of each business month end, we have this really rich data set across every portfolio business, so we can really assess what we need to do and how we need to help. Within the portfolio team, we have specific skills that generally the businesses we back lack. So a lot of businesses that have sort of less than 20 people, less than 30 people, don't have a HR director, so they have access to ours. Kate has been hugely valuable during sort of the pandemic. So she's worked with every single portfolio company on furlough scheme, salary sacrifice, and to be fair, some redundancies that needed to happen during COVID. So those skills are hugely important. We also have within the business kind of a girl, Ruta, who has built her own enterprise as CTO, enterprise grade SaaS solutions. So she works with the CTOs within the business. We make our finance team available to the finance directors of the various companies to provide sort of support and guidance. And then we've got the likes of Andy Stumner, who runs the portfolio team, who has experience having run a fintech business and grown it from 3 million revenue and significant loss making to 15 million revenue, significantly profitable, and internationalized that into America, Singapore, and Australia. We've also built up what we call our portfolio toolkit. So this is a bunch of suppliers who we work with, recommend to our portfolio, either to add value to them, in terms of helping them grow, or to save them money. So a great example of that would be, we have partnerships with AWS and Microsoft Azure, so Amazon Web Services and Microsoft Azure. A lot of our businesses are tech businesses and spend a huge amount of money on hosting services. So during 2020, which obviously was a pandemic time, the partnerships we had with Azure and AWS saved our portfolio £700,000 of cash. So each portfolio business can get 100 grand saving on their tech hosting costs through the partnership we've built with AWS and Azure. We have similar ones with the likes of HubSpot. So HubSpot is a CRM system. We've helped implement that within 6 of the businesses we've backed, and they get a saving of up to 90% of year one cost by the association with us. Other partnerships we have include Granttree, who helped our businesses access over £2 million of grant funding in 2020. PwC on R&D tax credits, who helped our businesses generate an additional incremental £450,000 of R&D tax credits by going back in time, looking at old R&D tax credit claims and reapplying for additional credits. And that, so within those sort of handful of suppliers, we probably saved our portfolio or brought in additional revenue of somewhere in the region of £3.5 to £4 million across 2020, which obviously was well received during lockdown. And the final way we try and add value is through the partnerships we have with individual partners. And the next slide is one that I'm particularly excited about because this is very, very much hot off the press. So we have just launched something we're calling the Operational Partner Scheme, which is where we are looking to bring in people within the business who have been there, seen it and done it and want to work with our portfolio to help them grow. So Steve Corns was CEO and CFO of AO World. That floated in 2014 for 1.3 billion. I actually knew Steve from prior to setting up Praetura. As I tried to say, and he's probably one of the reasons why I'm doing what I'm doing, because we tried and failed to raise money for AO in 2010, which obviously was a poor decision that nobody wanted to back them, given it floated in 2014 for 1.3 billion. Steve is chairman of us, but also one of our operational partners. So he's currently working with 2 or 3 of our portfolio to help them grow. So he sits on the board of a number of our portfolio. The other 3 are kind of new additions to us. So Colin Green, up until last year, was living in Cupertino, working for Apple, where he was Senior Director of Consumer Retail, which means he was responsible for Apple's operations selling to the likes of Best Buy, Target, Walmart, etc. His budget within Apple was 17 billion of revenue per annum, and he reported directly into Tim Cook. He's moved back for family reasons back to the Northwest and is working with a number of our portfolio businesses to help them scale. His expertise is phenomenal, and he's really bringing kind of that Apple approach to some of our portfolio businesses, which is really hugely well received. Don McGregor is a 27-year-old co-founder of Social Chain. They exited that. He grew that business from his university Twitter account, University Problems or Uni Problems, I think it was, to a 200 million social media business that was floated in Germany a couple of years ago. Dom has stepped back from that business and is now spending part of his time working with us to help us with our marketing, but also to help portfolio businesses with growing and going, and particularly around their marketing activities. And Mark Slade is a co-founder of OSTC, which is a training business that is on the cusp of £100 million plus flotation. Mark stepped back to sort of non-exec within that business a couple of years ago. He was introduced to us and has now agreed to come on board as an operational partner to work with a number of our portfolio businesses. And his real expertise is around kind of learning and development and skills development within businesses. So he very much looks at the culture and the learning environment in which the businesses operate. So those 4 guys, and there will be more, are kind of really how we really try and differentiate ourselves and also really try and add value, because I'm sure you'll agree that the experience of those guys is incredible for businesses who are at a very early stage to have access to. And I guess one thing on those guys as well, and really importantly, they're all fantastic people who really want to add value and help. They're amazingly egoless, and I just can't speak highly enough of the guys and how much they've thrown themselves into getting involved with our portfolio. Final bit, open, transparent communication. So we do regular detailed reports. So twice a year we do a written report for anybody on the call who wants to see what that looks like and how much information we provide. Very happy to send that on after this call. We do video calls with all investors. So following each of the half-yearly reports, we do a video call where investors can speak to me, the investment team, the portfolio team, anyone within the business around how each business is performing. And we also have a portal for EIS and various reports. EIS, for those of you who've kind of been involved, HMRC seem to make it as difficult as it possible to be to get the EIS certificates back and into the hands of investors so they can claim their tax relief. We try and take as much of that headache away. We get advance assurance from HMRC ahead of pretty much every deal we do. We put our EIS forms into HMRC on the day we complete, and that has allowed us to get to a position where we generally get our EIS forms back to investors within about 8 weeks of investment, which is, you know, fantastic for us. They're all held on the portal, and investors can invite their advisors, their tax accountant, whoever it may be, to access their information, which means they can get all the EIS certificates in a relatively pain-free way from our portal, which I think is really important. So summing up, kind of what we do, we back recurring revenue B2B focused businesses. We're generally not B2C. We back teams, not individuals. I didn't talk about this, but we fund things properly in our mind. So we're always looking for kind of 18 months, 2 years of runway when we first invest, because inevitably things won't go to plan. Things will pop up that you didn't expect, and you will get bumps in the road that you need to deal with. That funding things properly has been hugely important to us during COVID, which clearly is much bigger than a bump in the road. But thus far, you know, I'm pleased to say all of our portfolio have come out the other side and are actually in a really good position now to really attack the opportunities on the other side. We do a lot of diligence pre-investment, but we're also diligent post. So with our system, we're always seeing where businesses are up to, and we try and work with the management teams to ensure they don't just carry on with their hiring plans if their revenue plans are not being hit, because that's where businesses get into real difficulties and the cash burn gets out of hand. We utilize our entire team's expertise, you know, and that includes our operational partners. And then we're monitoring using real-time insights. So we, you know, as I said, we get our information very quickly and on a very light touch manner, so that we can assess them and really work out where we need to focus our time, effort and attention to maximize the returns for investors, but also minimize risk on the other side. You might ask how the last 12 months have gone. So this is an extract directly out of one of our October update. So as you can see kind of here, this is the aggregate turnover of all the businesses within the 2019 portfolio. It grew really nicely up till quarter 4 2019, flattened off during COVID, and has now just started to grow again. Similarly, headcount grew, flattened off just after COVID, and is now started to grow again. I think both those sort of graphs really show the impact of COVID, but also probably the other part of this is just how resilient the businesses were. So they weren't, you know, you didn't see a huge drop off in revenue during COVID. We were relatively flat because businesses, well, you know, we have a recurring revenue sort of focus. So businesses were able to keep hold of the customers they'd already won. New sales were difficult, but they were at least able to keep the revenue flowing. And we didn't have any businesses where you had a shop estate or you had people needing to, you know, or leisure, where, you know, revenue just fell off a cliff across, you know, the beginning of the pandemic. We have had some great successes during COVID. So Peak is a business we've been back for a long time. Over the course of June 19 to December 20, they grew 340%, going from 2.1 million ARR to 7.8 million ARR. Equally, they managed to sign a deal with Ox Capital for 12 million of additional funding at a 54 million pre-money valuation, and they had almost zero churn from their existing base. That is a fantastic business that we, you know, really enjoy working with. Richard Potter, who's the CEO, is a fantastic leader. They took really quick action at the beginning of the pandemic, and they've been able to sort of continue their growth story across the pandemic. It's been fantastic. Similarly, a business called Patchwork was a business we backed. The graph is slightly out of date, but from January 2020 when we invested to now, they have pretty much tripled their ARR, going from 650 grand of ARR to they hit 2 million in January 2021. We have really enjoyed working with them. We think there's a huge opportunity. They've done pretty much everything they said they would do when we first invested, such that we invested 1.8 million in January 2020. We've just underwritten a further 3 million investment into the business. and we've completed on 2 million of that investment. This is one we really see as a huge opportunity, and one we think will go on and do fantastic things. In terms of sort of all of the portfolio, we identified and we shared with our investors around April time in 2020, where the businesses were from a cash perspective and what we expected to happen post-COVID. We have raised money for 7 of our companies. They've raised about £35 million, of which Praetura has probably only done about 2 or 3 million of that. So we've raised sort of 30 million plus externally for our portfolio. All of the deals, apart from one, have been either at the same valuation we invested in or an increase in valuation. There was one down round, which is a business called Steamaco, and even in that regard, there was a down round, but we were able to negotiate on behalf of our 2019 fund investors effectively an option where they could mitigate a large proportion of the effect of the down round should the business perform in the future. We even, despite the fact that we had a down round, which is something that happens and isn't something to be ashamed of. I think a lot of VCs are really afraid of a down round. We negotiated that up front. We took the lead on the deal. We raised £3 million, of which Praetura did 300 grand of investment, and we protected the downside for our investors. So we think we actually did a great job despite that being a down round. And now I'm pleased to say that as at December 20, all 13 portfolio companies have over 8 months runway on cash, which is a fantastic achievement outside, given COVID, given the difficulties in the outside world. All our businesses now have runway and opportunity to go on and do great things in 2021, where we think the opportunities will really accelerate. So what do we see for the future? We think the businesses we backed pre-COVID are relevant today. We think our investment thesis doesn't need to change. The things we liked pre-COVID, we still like now, and we're excited to back them going forward. We have kind of a number of sort of themes that we really like as opportunities. So health tech, health products is something we're particularly excited about. We have a number of sort of businesses within that space, one of which is a Innertech, which is a wound care business, which despite sort of working in the American health system, which has been relatively shut down, still we think has got a huge opportunity. And the testing they've been doing during sort of lockdown, proving out that the efficacy of their product has been incredible. So we're really hoping for great things of that in 2021. And we're looking at one business now that has just seemed to have come out the other side of a relatively difficult time. They've just won a £3.5 million contract, and we're looking to back that in the next 6 to 8 weeks. Healthcare efficiency is something that's really important to us. So kind of all the digitization of health. So Patchwork is in that space. And we're looking at a number of other opportunities in that space. Our big theory there is that businesses that are already, and tech businesses that are already serving the NHS and have a great reputation with the NHS will likely expand. So we're looking for businesses that are already in the NHS system rather than businesses that are trying to break through the door and get in. Because we think that the NHS, whilst it has opened up for digitization, is really looking for trusted partners rather than to bring in lots and lots of different suppliers within what is a huge organization. E-retail infrastructure is really important to us. So we have 3 businesses in this space. We, as a B2B sort of focused investor, are unlikely, in fact probably won't back any businesses, the likes of Boohoo, things like that. We're not looking for the next big e-retailer. What we do like is backing businesses that provide, that power those e-retailers. So Sorted and Peak are both, strong in e-retail. Our last deal, Rapid Spike, is a cybersecurity business that sort of, works with e-retailers to help protect them and identify cyber attacks on their websites. And that whole area of sort of e-retail infrastructure is something we're particularly excited by. Digital alternatives is something that's grown during the pandemic. So basically anything where we are taking what used to be a physical experience and turning it digitally is interesting. We are very close on backing a business now that is a digital events business that uses game engine technology to provide an immersive experience for digital events and also for kind of turning physical spaces into interactive landscapes that people can access digitally. So anybody who's sort of relied on things being done, in person physically, are able to use this technology to provide kind of a digital alternative, and that's something we're interested in. And the final one, we see a lot of opportunity in this space, but we haven't really backed any yet, is kind of banking products. So we have a theory that, the banks, the traditional banks of kind of yesteryear, with their incumbent people, their legacy systems and their legacy kind of infrastructure, as well as the increase in regulation, are a fading force in the UK economy. And we think that all the various fintechs that are coming in to take over parts of the old suite of products within banking is really interesting. One of the things we're particularly interested in is the open banking architecture, which allows fundamentally any business to become a bank and provide all of those services from a payment perspective. And we think that's a very exciting opportunity. And actually, given sort of where Leeds is, with a high proportion of sort of financial services businesses, and also Manchester as a kind of a growing tech hub, a lot of those opportunities are being built in the north of England, and we're excited to back some of those in the future. And then final bit from me, we have an evergreen EIS fund open. Our next close will be March 2021. That will be deployed within the 6 months to September 2021. So tax relief available from in either tax year 22 or carry back to tax year 21. We are, as I said, we're very close on 6 deals, which will take up all of our available capital, and then will form the basis of kind of the first few deals within the next soft close. And then we have behind that a huge amount of opportunities. One of the things that's probably not been mentioned in the presentation to date is we're now seeing about 50 million of funding requests a week through our pipeline system, which obviously gives us huge access to opportunities. Given we're looking to invest maybe 20 million quid this year, it means that we're really investing in 1% of what we look at. And we think that as we've sort of built the business, as we've become more and more well known, the pipeline is increasing, and equally we're getting better at knowing what's the right deal for us. So I would say, anecdotally, the pipeline of what we're looking at now has never been stronger, whether that's due to pandemic, whether that's due to us, whether that's due to just, one of those things. It's a fantastic place to be in, and we could easily deploy much more than we are able to raise in any one given year. So that gives us real hope that we can deliver a really exciting portfolio of businesses to our investors over the coming 6 to 12 months. And that is me. So thank you very much for listening. I've got I was just checking if we got something on chat because I hadn't seen that before, but I guess, Angela, back to you and questions from your investors.
Yeah, so if anybody's got any questions, now's a really good opportunity to put them to Dave or to Steve, who's also here from Praetura. Anybody got any burning questions that they'd like to put forward?
It's Alan Hitchinson here. Thanks very much for that presentation. Very interesting. You talked about the future. So what if a little investor like me came along and wanted to put some money into your organisation? What sort of returns could I expect in the next 12 to 24 months?
Well, I think first things first, EIS is a three-year minimum hold. So returns in the next 12 to 24 months would be sort of, I guess, theoretical spreadsheet gains rather than returns. But
Okay.
what we're looking for is to return, and it doesn't say this in the IM, but what we're looking for internally is 3 times money. So if someone invested 100 grand, we would expect to return them 300 grand of capital. Obviously, you would then benefit from the EIS relief available of, say, 30% on the way in, and then tax-free gain on the way out. So that's what we're internally aiming for. I think the EIS average across kind of the EIS average across kind of the entire industry is something north of 2 times, somewhere between 2 and 2.5 times money. So we're trying to beat that. Obviously, that's what we're aiming to do. But yeah, you're looking at kind of 2 to 3 times return. Obviously, we're hoping that we could have a stellar success like Inspired Energy or EC3 or Sorted or Peak, in which case the opportunity is higher. But I guess on a portfolio perspective, that's what we'd be looking to do. And in terms of an investment, it's probably we would be looking to start exiting businesses in year 4. I suspect that you'd have to expect that over the businesses will be exited across year 4 to year 7 of the investment horizon.
Okay. All right. Thank you very much.
I think just to pick up on the point that you make, Dave, about the typical return, that there's a very wide range of companies that are operating in this space, and some of them very much concentrate their focus on tax relief. And the thing about an EIS is that it is a higher risk investment, but it does bring with it some quite interesting tax benefits. Obviously, Dave's mentioned the 30% tax relief, but it also, apart from being capital gains tax free after 3 years, it also qualifies for business property relief after 2 years. So in some cases, that's really what the companies are looking for. And what they do is they try and put together a package which potentially reduces the risk and potentially reduces the returns. So this is a very different focus. This is looking at the pure quality of the businesses that Praetura are investing in the first and foremost. And obviously, with those sort of potential returns, which obviously can't be guaranteed, but those sort of potential returns, obviously the benefit of the tax relief obviously sweetens that deal, but also it means that you've actually got a much more investment focused company here that's looking for the quality, the returns, and aiming for that kind of 3 times investment puts it at the opposite end of the spectrum from some of the other companies that are out there.
Yeah, just picking up on that, Andrew. Yeah, we make no bones about it. We are a VC who happens to raise money via EIS. So we're a venture business. We are making investments to make significant money multiple returns. That is what we do. We just happen to raise money via EIS. We're not an EIS provider who then, I guess the other way around of looking at that is raise some EIS and then try and find something to do with it. We are just to monetize the tax return. So we're very much focused on the investment, and we're very much focused on maximizing the return once we've made those investments.
Has anybody else got any questions?
Could I just add something there?
Sorry.
Yeah, similar lines. This might be something for Steve or Dave to answer. It's about sort of managing clients' expectations in terms of exiting these kind of products, because obviously investors with us are probably used to quite liquid assets, whether it be stocks and shares, ISAs. We could set it up today, get the money out in a year's time. They're quite accessible. EIS is very different.
Yeah.
You've already touched upon the 3-year rule, so I've got to stay in there for 3 years to retain that tax relief. But could you give us an idea of how it's likely that clients would exit this?
Yeah, so there's, I guess, any sort of investment into a private company there's 3 routes available really to exit. So you'd be looking at an MBO, you'd be looking at a trade sale, you'd be looking at a flotation, and those are all available for our portfolio. We are seeing some interesting sort of acquisitive approaches to some of our bigger businesses right now, because they're in interesting spaces. So, you know, were we to want to exit, we could exit a couple of the businesses right now. They've obviously been for a while. But the really interesting thing for me is, as we grow these businesses, one of the things that's really becoming more prevalent is when you do the next funding round or the big funding round for any of these businesses, there is often an opportunity for secondary market sort of sales. So if you take the Ox deal with Peak, for example, whilst we raised £12 million for the company, there was also 4 million made available at the same price for early stage investors to exit and sell their stakes. If we were doing a deal with, we're doing a deal now with Patchwork where the same thing applies. So, people are looking to exit those businesses, not our investors because they've not been in for long enough, but early stage investors. So that secondary kind of exit where there is not a sale of the business nor an exit of the business in entirety is something we're really looking at, and we're building our relationships with the kind of funders, the US VCs, the large scale VCs in London, who are able to provide that facility. And also we as a business are, over the next couple of years, we'll be looking to launch our own sort of secondary market fund where we can provide liquidity to our investors, because one thing that's really important from an EIS perspective is recycling cash. You don't want to be sat there as an EIS investor and find that you've got some interesting businesses, but you're still invested in them 10 years later. There has to be an exit period. So, we're looking at ways in which we can build the partnerships to allow our EIS investors to exit at the appropriate time. B, we're also looking at ways in which we can build our own, exit machine, as it were, which is a fund to specifically buy out our EIS investors, as well as provide additional capital to kind of the best of the best within our portfolio. So it's a really interesting part, because one of the dangers with EIS is it's a long-term, and you're right, it's a long-term investment. And it all comes down to the portfolio businesses and each individual business when's right to exit. What we're trying to do is build our relationships and our own ability to make exits more achievable for our investors.
Is it possibly worth touching on it in the context of John's question? So you talked about how we construct a portfolio and build diversification through seed developments and growth, what that might look like from a timeline and how that feeds into the investment journey. Yeah,
so I think, yes, it's a good point. So the growth businesses within any portfolio, we kind of take the view that they are, they're not liquid, but they are much more liquid than the seed stage businesses. That's just a function of timing and a function of kind of the speed at which they're growing and I guess a function of risk. So of the sort of growth businesses within our portfolios to date, there is liquidity in kind of 3 or 4 of the businesses already that are at the top end of our investments. So Peak, Patchwork, Sorted, Innertech are all kind of, we could engineer liquidity in those businesses if we wanted to now. So for those who invest in the 2019 fund, in 2022 and 2023, we will probably be looking at an opportunity to realise some of that capital. I think for some of the earlier stage businesses that are, the likes of Culture Shift, which is, very early stage tech for good business, they're in the seed stage of life, and they're probably not going to be realistic exit opportunity for, say, 4 or 5 years, and that's at the front end. So by looking at kind of diversification across sectors and also looking at diversification across kind of stage of business, we think that we can create a portfolio where earlier, shortly after the EIS window, there is some liquidity available. But then that goes on across a period of time post the end of that EIS window. So we're trying to make sure that the cash is returnable within a reasonable time frame and not just all sat there waiting for 7 years.
Thank you.
I have a question.
Yeah.
Could you talk a little bit more about how you actually work with your portfolio companies? who's going in and working? Who are your team that are actually working with them to help them?
So the way we work with our portfolio businesses is run by the portfolio team. So we have an investment team, we have a portfolio team. So Andy Sumner, I mentioned on sort of the presentation, sort of heads that portfolio team. Within that team, there's sort of 3 or 4 people within our business who would work on a day-to-day, month-to-month basis with each of the portfolio businesses. We always have an investor director and an observer right on every business, so we would always attend every single board. That could be someone like me, that could be one of our operational partners, that could be Andy Sumner. On some occasions, it is one of the senior people within our investment team. But where it is one of the guys from the investment team, we would usually try and supplement that with another relationship across the business. So one of our operational partners, for example, one of our venture partners, who we also have a program for that, who have more experience of building and growing a business, because our investment team haven't run businesses. They generally have come in and they've gone through a traditional route of accounting or whatever it is, and then investment banking, and then joined us as a venture capital business. So I guess the overarching way we work is it's across the team. We have kind of individuals who would work closer with certain businesses, and we're always making sure that we have kind of real experience working with each portfolio business, not just an accountant who's going to ask, why have we paid Jean an extra £5,000 bonus this month? Because that's not really adding any value. So the people who go on, the people who work day to day, month to month, are people who've run businesses themselves. And that's why, I'm so excited about kind of the operational partner thing, because to have those guys available and we've got more who we're going to bring in over the next couple of weeks, months, to have those guys available to speak to the founders is just incredible. The mentorship and the value add is superb. And I've benefited massively from Steve Corns being chairman of this bit of our business, just from having someone to talk through about how we're growing the business, because we're a growing business ourselves. We're by no means the finished product. The team we're building is by no means the finished product. So even just myself, I've seen huge value in speaking to someone like Steve, and I think everyone in our portfolio team really, and the portfolio founders, really value that expertise and the ability to reach out to Colin Green and talk to him about what do Apple do and how is that relevant to what we do as a small Manchester-based startup, or to Don McGregor about how he was 20, he's 27 and he's exited a business already that grew to 200 million revenue. That experience is invaluable. So that's really what we're trying to lean in on. And on top of that, we then add certain skills that I talked about, so HR or tech or finance, finance control, things like that, to try and supplement skills that we find are often not necessarily lacking, but they're not as well invested in as you would, because they're early stage businesses. They've only got 20 people, and 20 people can only do so many things, and have so many skills. So that's really the way we approach that. Did that make sense?
Yep, thank you.
David, can I ask a question for you? Thank you very much for the presentation. I enjoyed it. My main concern is that when you enter anything like this, an investment, that EIS is notoriously a risky investment. And I would want to understand more about your success and your failures so far. That would give me a better comfort feeling if I was to invest moving forward, to know how you've coped. I'm sure other people that are looking to invest, it will be a concern for them to see how you've been able to, what's your success rate, and in a little bit more detail, so we can see if you feel moving forward.
Yeah, so we obviously tried to highlight some of that in the presentation. It's very hard to get that across in presentation format. What I would say is we've been diligenced by, Steve, is it three providers now? So there are businesses out there in the world who review EIS funds and EIS fund managers. We've been reviewed by 3, and would be very happy to share those reports, and they go into that detail of every investment we've made, every investment that we've looked at, and where we've succeeded or failed from a financial perspective. We also very happy to, if that kind of summary done by the external diligence provider isn't enough, we would be very happy to share all our data with investors. We pride ourselves on being transparent, so very happy for you to speak to kind of our guys in the team who look after all the numbers. And then I guess the final thing really is the thing from there's a track record point, and then there's a what are we currently investing in, and what we're able to do with investors is share all of our investment sort of papers, so people can see what we're looking at now and the diligence we go through that process. So I'm not quite sure. It's very difficult to go through 10 years of history in 5 minutes, but very happy to share that data with you if that's something you want to look at, and we can share as much or as little as you need to get yourself comfortable.
Yeah, we can have another chat about that, Simon. I'm happy to just pick that up with you at a later date if you like. And what I would do, would say as well, is that obviously there might be questions that all of you have got which may potentially be a little bit more personal than you want to go into on the forum like this. So if I can invite you all to contact your normal advisor at Acumen, and we can just pick up any particular queries that you've got and look into any concerns you've got, or how it would work for you, and how this actually would integrate with your existing portfolios and your existing financial plans. Has anybody got any other questions before we wrap up for this morning? Is there anybody else would like to make a point or ask a question? Well, I think that sort of concludes our latest client event, which we've said before, we've moved on to Zoom because we do these kind of things quite regularly for clients on topics of interest, and we hope that you've enjoyed it and found it enlightening. Certainly from my point of view, when I look at the news, the news rounds that we tend to see very much focus on all the doom and the gloom, and I think what's really important about all of this is there's some really spectacular success stories out there, and they're not that far away from where we live. They're all in that, that sort of Liverpool, Manchester, Leeds corridor. And it's just wonderful to have a company like Praetura who actually have identified with that. And a point that Dave made at the very beginning, and I've said this plenty of times actually, I think we're quite a hard-headed bunch up in the north of England, but actually what that means is that there's some really good opportunities for good deals up here that then can be grown into better deals when they're taken nationally, and they've had that input from a company like Praetura. So I'd like to thank you all for joining us today. Do come back to us with any queries. We'll follow up with a quick email just summarising a few points about EISs that might just jog a few more questions from you. And if there's anything else that we can do for you, then please just get in touch with me, John, Celia, Phil, whoever it is that you normally deal with at Acumen, and we'll be really happy to help you take this forward. So thanks very much, Dave.
Thanks, Angela, and thanks everyone.
Thanks, everybody.
Thank you.
Thank you.
Cheers,
Have a
guys.
good day.
Thank you.
Cheers.
Bye.
Bye.
Bye now.